Assalamualaikum and good day everyone. In this video, I will discuss a topic on the end of your accounting in an attempt to complete the accounting cycle before we move to other topics. Specifically, we will discuss adjusting entries and corrections of errors. And from there, we shall have the adjusted trial balance and preparing of financial statements based on the adjusted trial balance. For this discussion, please make sure that you have your ABC services exercise ready. Let's first talk about adjusting entries. We have talked briefly about the accounting cycle when we discussed accounting in business. Basically, we have gone through halfway of the accounting cycle when we did the exercises on donor delivery services and the adrenal cleaning services up until trial balance, and we did skip adjustments to trial balance to proceed to preparing financial statements. Today, I want to go one step back to adjusting entries, where we need to adjust the accounts and their balances when necessary to have them corrected and adjusted before preparing the financial statements. The adjusting entries include adjustment to accounts for any year and transaction, such as depreciation and tax that only appear at the end of financial year, corrections of errors, that is if we manage to discover them, and adjustment for accrual and prepayments if we have not done so. In this discussion, however, we will only touch on corrections of errors and adjustment for accruals and prepayments. Before we discuss the adjustment at the end of the year, let me first illustrate to you further on how accrual basis accounting works. Before this, we have only discussed the recognitions of accrued revenue and other income, accrued expenses, prepaid income and expenses, and repayments of accrued revenue. During our gameplay, some of you have experienced all of these and also the utilizations of prepaid expenses and prepaid revenue. Let me illustrate what you have done by these three transactions. Let's say the financial year end of this entity is at every 31st December. On 30th of November, the entity paid rents for 4 months, including November, amounted to 20,000. On 20th of December, it received cash for services to be provided in January, amounted to 5,000. On 31st December, it received utility bills for the month of December, amounted to 500, and it has not been paid yet. So we have prepaid expenses, prepaid revenue, as well as accrued expenses. Can you identify the amount that shall be recognized in the current financial year and the amount that shall be recognized in the subsequent financial year? Let's work on the first transaction. On 30th November, the entity paid rent for 4 months, so that goes beyond the current financial year end. As at that date, the entity paid 20,000 for rent for 4 months, including the current month of November. So the amount that shall be recognized as rent as at that date is only 5,000, being the rent for November. The rest of the amount shall be recognized as prepaid rent. On 30th of December, when it is the time to pay rents for December, there will be no outflow of cash from the bank since we already made the payment earlier in November. So for December, we simply utilize the prepayment by taking out from prepaid rent expense and transfer that to rent expense account. At this point, we still have a balance of 10,000 worth of prepaid rent. That amount is meant for 2 months in the new financial year. Come 30th January, again, we need not make any payments since it has already been paid in November last financial year. So we simply take out from prepaid rent by crediting prepaid rent expense account and transfer that to rent expense account. On the 20th of December, the entity received 5,000 from customer for a service to be rendered in subsequent financial year. So as that date, we record the receipt of cash by debiting bank account and recognize a prepaid or unearned revenue as part of our liability by crediting the account. Come 15th of January, when the entity actually provided the service, there is no cash inflow since we already received the payment in previous financial year. So we simply need to recognize revenue by crediting revenue account and transfer the amounts of revenue from the unearned revenue account. On 31st December, the entity realized that utility bills for the month has not been paid yet. Therefore, it recognizes accrued expense by crediting accrued utility expense account and debit utility expense account. There is no cash outflow, but the expense for the month has been recognized. Come 5th January in the new financial year, when the entity actually made the payment, it will show an outflow of cash by crediting bank and eliminating the accrued expense by debiting the accrued utility expense account. So as you can see, we actually continuously updating and adjusting our accounts where necessary, following the transactions and economic events that we have. But the adjustment is more significant and relevant at the end of financial year, since that will be the separation between two financial years, where financial statements will be drafted upon. So even if we might do the adjustment continuously, we might want to check and recheck at the end of financial year, just in case. So what we do, for adjustment at the end of year, we simply make sure that the amounts of revenue and expenses that are relevant for the current financial year have been recognized accordingly. We need to determine that revenue and expenses are recognized in the year that they are earned and incurred respectively. Specifically, we need to ensure that all revenue and expenses are recognized in the correct financial year and at the correct amount for the year. We also do adjustment to properly measure the total amounts of income and expenses for the financial year, as well as the amounts of assets and liabilities as at the end of the financial year. Having said that, I want to highlight again that not all prepayments and accruals need to be adjusted at the end of financial year. It all depends on the timing of the prepayment and accrual. For example, given the financial year ends at 31st December, on 31st October, an entity paid 4,000 for current and subsequent month. So we credit bank, debit rent for the month, and debit prepaid rent for subsequent month. On 30th of November, we utilized the prepayment by debiting rent for the month and crediting prepaid rent expense made last month. So the prepayment expense account have been adjusted before year end. Now say on the 28th of October, the entity received 3,000 cash from its customer for service to be rendered in November. It records the receipt of cash by debiting bank and recognize a prepaid revenue. On 15th of November, when the entity actually provides the service, it recognizes the revenue by crediting revenue and debiting prepaid revenue received in previous month. Again, the adjustment for the prepayment done before end of year. Now say on the 27th of October, the entity received unified bill and no payment has been made for that bill till end of October. It recognizes the expense by debiting unified expense account and recognizes the accrued expense by crediting accrued unified expense account. On 5th of November, when the payment for the bill is made, it recognizes the payment by crediting bank and debiting accrued expense account to eliminate the accrual. Again, the accrual has been adjusted before end of year. Finally, on the 16th of October, say the entity provides service to its client but no payment has been received yet, it recognizes revenue earned by crediting revenue account and recognizes accrued revenue by debiting debtors account. When it actually receives the payments from its client, it recognizes the receipt of cash by debiting bank account and eliminating the debt by crediting debtors account. Again, the adjustment to an accrual or deferment is done before year end. So it all depends on the transactions and the timing of the economic events, not necessarily need be at the end of the year. Also, adjusting entries simply refer to journal entries for adjustment made to accounts and their balances. Having said that, Year-end adjustment or end-of-year adjustment may refer to, again, adjustment of accruals and prepayments, recording of transactions that only occur at the end of the financial year, such as depreciation, amortizations, and valuations of assets carried at fair value, and corrections of errors. That is, if we manage to discover them. So for today's discussion, we only focus on the first and the last adjustment in the list. Let me illustrate that by this simple exercise, ABC services. We are given the unadjusted trial balance for the entity where its financial year ends every 31st October and the current financial year is 2022. We are also given this information in relation to adjustment needed for the accounts and their balances. You may, if you want, try them on your own first. For that matter, you may pause this video and resume once you are done with the adjustment. For information number 1, revenue showed in the trial balance includes a prepayment made for future service. The amounts of 2,500 are meant for financial year 2023 and not financial year 2022. Thus, we need to adjust the revenue account by taking that amount out of revenue account and transfer to a prepaid revenue account. As a liability, the journal entry would be as such: debit revenue account and credit prepaid or advance revenue account. So in the trial balance, the amount of revenue will be reduced by the prepaid revenue amount and new account is created. Information number 2 reveals that the final month's rent has not been paid. This means that the total amount for rent expense should be 24,000. The amount in the account is not enough. So we need to add to that amount to make it to 24,000, the relevant rent expense for the year, by adding 2,000 to the rent expense account and creating new accrued expense account as the liability. The journal entries being as such, with balance in the rent expense account now becoming 24,000 as it should. In the trial balance, the amounts of rent expense will be increased by the amounts of accrued rent expense and new account is created. Information number 3 reveals that the owner of the entity uses the entity's bank account to make payment for personal transaction. And the fact that he has no intention to repay the amount make it a withdrawal by the owner. So instead of utility expense, it should be recognized as withdrawal. The amount shall be taken out from utility account and transferred to the withdrawal account, which is an equity item. The journal entries shall then be as such, where the balance in utility expense is adjusted to 2,800. Now this is an example of corrections of error. In the trial balance, the amount of utility expense is reduced by the withdrawal amount and new account is created. Information number 4 reveals that utility expense for the year should be amounted to 2,420 ringgit. However, after the earlier adjustment, the amount recorded was at 2,800. Thus, there is an excess of 380 ringgit, indicating a prepayment. So we need to take that amount out of the utility expense account and recognize the prepayment, which is an asset. The journal entries are as such, with balance in the utility expense account becoming 2,420 as it should be. In the trial balance, the amount of utility again will be reduced by the prepaid amount and new account is created. Information number 5 reveals that in the total amounts of rent income, there was prepayment made for future rents by the renter. So what relevant to the current year is only 150 ringgit, while the balance is payment in advance. So it should be taken out from rent income account and transferred to a prepayment account, which is a liability. The journal entries are as such, but the balance in rent income account becomes 3,010 ringgit. In the trial balance, the amounts of rent income will be reduced by the prepaid amount and new account is created. Information number 5 also reveals that another renter has not paid his October rent amounted to 110 ringgit. So this will be an amount relevant to financial year 2022 and shall be added to the rent income account and transferred from an accrued income account, which is an asset. The journal entries are as such, and the balance in the rent income account now increased to 3,120 ringgit. So in the trial balance, the amounts of rent income will be increased by the accrued rent income amount and new account will be created. Finally, information number 6 reveals that a repayment of debt by a customer was omitted. So this is another example of an error. This amount is relevant to the financial year 2022, thus it shall be added to the bank account to reduce the amounts of debt for debtors. The journal entries are as such, leaving the balance in bank account increased to 49,515 ringgit and balance in debtors account reduced to 11,755 ringgit. In the trial balance, the balances in both accounts will be adjusted accordingly, no new account created. After the adjustment, we are left with adjusted trial balance with few new accounts and new balances for some of the existing accounts. Now, if I were to rearrange the list by the group of elements of financial statements, it will look something like this. So all that are left to be done is to transfer all of these accounts to their specific financial statements. Income accounts to income statement, liability accounts to balance sheet or statement of financial position, capital and withdrawal accounts to statement of changes in equity, assets accounts to balance sheet or statement of financial position, and expense accounts to income statement. As we can see here, the debit side of the trial balance is equivalent to the credit side of the trial balance. Thus, we can be sure, after the adjustment, that the recording are all correct. So from here, if you have not done so, please proceed to draft the 3 financial statements for ABC services.